technical guy and publisher of the Lead Lag Report. Joining me there is James Connor. James, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in critical resources, and what are you doing currently?
Well, thank you very much, Michael. Once again, my name is James Connor. I've worked on the sell side for 20 years, and a few years ago, I started a corporate access firm called Bloor Street Capital, which is based in Toronto. And as a few people might know, Canada is a resource-focused economy, so this is the focus of our firms. And we try to educate investors on the importance of minerals and how investors can make money from this sector. And these minerals might include precious metals like gold and silver, base metals like copper, or battery metals like lithium and nickel. And the platform we tend to use to educate investors is YouTube. And we hold the virtual events on YouTube focused on specific themes. For example, last month we had a conference on copper and how copper is needed for electrification. Earlier this year, we had a virtual conference focused on EVs and battery metals. And once again, we had numerous speakers on just to speak about the growth in EVs around the world and what raw materials would be needed to fuel this growth and how you can make money in this sector. I mean, that's why we do this is we're trying to educate people on how to make money. And I should let your audience know, Michael, that we're holding another virtual conference this coming Friday, June the 23rd at 10 a.m. The conference will be focused on precious metal royalty companies and how royalties can benefit a portfolio. And once again, it's going to go live on YouTube at 10 a.m. Eastern. And if you can't watch it live, it goes right into replay mode, so you can watch it at your convenience, and just a ton of free information on there. And on our YouTube channel, which is Bloor Street Capital, you can find information on copper, battery metals, uranium, and nuclear energy, and anything that comes out of the ground. That's what we pretty well focus on. Each conference we do is really focused around that. We try to get industry experts on, people that can speak about that have specific knowledge on the sector that we're doing the conference on. So this conference we have coming up this Friday, we have John Reed from the World Gold Council. He's going to speak on supply and demand fundamentals of gold. We also have Mike DiRienzo from the Silver Institute. He's going to speak on the supply-demand characteristics of silver. And we have a portfolio manager on, Dave Iben. He's from Copernic Global Investors. He's going to speak on why he and his firm is bullish on gold and more specifically precious metal royalty companies. So I would encourage your listeners to check out our YouTube channel, Bloor Street Capital. And once again, you can get a ton of free information on there on anything and everything to do with resources.
All right, so you mentioned the different areas that you focus on: gold, silver, copper, nickel, lithium. From your experience or from any kind of historical testing, what commodities tend to have, from your perspective, the most interesting signaling power on the economy and risk sentiment? So you often hear about Dr. Copper as an example, and I've tested that, right? And copper does have some leading aspect. I don't think it's as strong as people would have you believe, but aside from copper, what else do you find has some predictive power?
That's a very good question, and I don't know if I could truly answer that in terms of, I think I would reframe it, Michael, and say, where do we find the most interest? And it definitely has to do with nuclear energy and uranium. And when I say the most interest, that's where we get the most number of views, and we get the comments and the likes and all the engagement, and we get the most number of people signing up for our events. Anything to do with nuclear energy and uranium. In terms of protecting what's happening in the economy, that's very tough, because what really drives any of these events that we do, it's how well the underlying commodity is doing. That's pretty well the number one driver, because everybody just wants to make money.
Yeah, and I've had a number of guests talk about uranium, and those that get it are extremely passionate about the argument and case for uranium. I think makes a lot of sense from a not just logic perspective, but just even ESG as sort of your cleanest source of energy. But let's face it, uranium has been hard to invest in. So since your focus is on how to actually make money from some of these themes, when you think about uranium in particular, what are some of the ways that you find are good, as close to pure plays as possible in the context of a lot of volatility in the space?
So the number one asset or security that I would invest in would be I always go for the ETF, the physical. There's one that trades in Toronto. People refer to it as SPUT, S-P-U-T, or the Sprott Physical Uranium Trust. And when you're buying that product, you're actually holding the raw material. And it's no different than trading the GLD for gold, for example, right? And of course, and then from that, then you can go down and you can look at uranium producers. And the world's largest uranium producer is called Kazatomprom, based in the country of Kazakhstan. It trades on London, and I believe the symbol is KAP. And the second largest uranium producer in the world is called Cameco. It's actually based in Canada, and it trades in New York under the symbol is CCJ. And a lot of people like that one just because of the jurisdiction, right? There's no jurisdictional risk. It's done very well. I'm not sure what it's up this year. It might be up 30+% on the year. And to your point, one of the reasons why, especially institutional funds that do manage a lot of money, they can't invest in this space because the space or the sector is so small and there's so few names to invest in. And I believe even with a name like Spot, for example, the market value is maybe $3 billion. Cameco, I think the market cap's a little bit bigger. It might be $8 billion. Kazatomprom, it's a lot bigger. But once again, you have the jurisdictional risk of being in the country of Kazakhstan. And then out of those two top producers, then it gets pretty thin, right? Then you have a number of development companies and a number of Explorco companies.
Yeah, and the geographic part, I think, is always the challenging part for a lot of people, right? Naturally, we have home bias, so we want to invest in companies that are within our borders, even though we know there's exposure to all kinds of companies and dynamics outside of our borders. But there's also the geopolitical risk, clearly, right, when it comes to getting access to this type of investment.
Oh, geopolitical is huge with any sort of mining, but especially uranium. And we could probably have a whole discussion just on uranium and nuclear energy and what's happening within that sector. And just to throw out a few numbers for the listeners, Michael, but from a supply-demand point of view, the demand is 180 million pounds annually, and that's what's needed to fuel all the nuclear reactors around the world, which is approximately 450, okay, that are currently running right now. The supply is around 130 million pounds, so you have a 50 million pound deficit every year, okay? Now, those numbers might vary a little bit, but nonetheless, you're running at a big deficit every year. And one of the big issues with is Kazakhstan, or the country of Kazakhstan, they supply approximately 40% of the world's uranium. Okay, that one country, and of course it borders on China, also borders on Russia, and a lot of people refer to Kazakhstan as a quasi-Russian state. So there's risk that Russia might intervene and might somehow hamper the flow of uranium to Western countries that need it. And I'm sure a lot of your viewers don't know this, but the U.S. is the world's largest consumer of uranium. Approximately 20% of its energy comes from nuclear power. And they need approximately 50 million pounds a year just to keep these nuclear reactors going, okay? So this is one of the issues. This is why we haven't seen sanctions on Russia yet, because they're a big supplier of not only uranium, but also of the conversion or the end product that goes into the nuclear reactors. So once again, to your point, jurisdiction and geopolitical risk is a huge element within that sector.
What's going to take to get some FOMO, some real momentum, right? So I get it. A lot of people love the theme. They understand the risks. But yeah, anybody that's just sort of a chartist or a technician, it's been hard to try to want to even get some activity going there, right? There's the longer term investment argument, but then there's the trading momentum side, and it just doesn't seem like the momentum wants to stick. What's going to take to get some follow through, you think?
That's a great question. People ask me this all the time. And I think it's happening. It's not happening as fast as people want, because of course everybody wants to make 25 or 50% today, right? But I'm telling you, from a supply demand point of view, I don't think there's another sector out there that has better fundamentals from a long-term perspective than nuclear energy and uranium. And like I said, there's not too many names, and this is one of the issues because there's so few producers of uranium. But if you look at Cameco, for example, it's already had a big move, and I think it's going to go a lot higher. And if you want to play an ETF, there's also ETFs you can play. And if you want to play the spot, you can play that. But what's going to take it higher? I think it's just a continuation of this whole movement by governments around the world toward this green economy, decarbonization, and it's going to take time. And there's still a lot of pushback in a lot of countries about nuclear energy. Australia is one that comes to mind. They do not allow it. But I think as governments continue to push toward this decarbonization and green economy, we're going to have to adopt more and more nuclear energy as a power source. You can't get it from coal, you can't get it from nat gas or other fossil fuels. You got to go for these cleaner sources. And I should also point out another big driver of this whole sector is going to be China. And we've seen this with China in so many other sectors, but China currently has the biggest build out of nuclear reactors in the world. I believe they currently have 50 under construction as we speak, and they're going to need a lot of uranium. And this is one of the issues is sourcing it, because they produce a very small amount of uranium, but not nearly enough to fuel all their nuclear reactors. They currently get, believe it or not, their number one source of energy still comes from coal. I believe it's around 40 to 50%. It was as high as 60%, so it's coming down. Nuclear energy is only 5%. They want to move that up to 20%. So their demand for uranium is going to go exponential. And as we know with China, I mean, this is one great thing about that country. They always think long term. So they're going to be stockpiling tons and tons of uranium to fuel this nuclear reactor industry in the coming years.
Yeah, and I've also had a number of people talking about just the general movement in China there, because to your point, they don't care about the bureaucracy that comes with and political back and forth, right, that comes with discussing nuclear and uranium. Okay, so that's on that end. Let's talk about other areas that you focus on. You mentioned lithium. Last I checked, lithium was actually on a pretty good tear. I may be wrong on that, confusing charts, but where are we with lithium demand supply dynamics, and are there any sort of interesting dynamics that you can point to?
Yeah, another very interesting sector, and this is another sector that's just exploded here in the last 3 years. And once again, it's the growth in EVs that's driving this whole space. I believe in 2020 there was 6 million EVs produced globally. In 2022, at the end of 2022, that grew to over 10 million. And this year, they're estimating that's going to go to 15 million EVs globally. Okay, and of course, they require a lot of lithium, and then they also require a few other metals in those batteries. Lithium-ion batteries. They need nickel, they need cobalt, they need manganese. And so that's what's driving the lithium price. I believe it peaked around $70,000 to $80,000, and it's pulled back significantly here this year. The lithium market is very much like the uranium market, is that it's not a very mature market and it's not very transparent. So there's a lot of activity going on there, and you don't really know what's driving the price or how much is driving it. The problem with the lithium spot market, the number one market is in China, so there's not very much transparency there, right? You don't know how much or how many pounds or how many tons is taking it up to 70,000, and you don't know how much volume traded to take it down to 40,000. But the long and the short of it is everybody needs a lot of lithium. And one of the issues with lithium, once again, there's not that much of it in the world, right? Your number one producer in the world is Chile, and then Argentina. Australia is also a big producer. But all of these OEMs or all these car companies like General Motors, Ford, Tesla, all of these guys are scrambling to secure supply because they got these massive, aggressive growth plans in pumping out these EVs, and they're not going to be able to do it. And they're not going to be able to do it because there just isn't enough lithium being produced. And this is why earlier this year you saw General Motors make a $650 million investment in Lithium Americas. LAC, I believe, is a symbol in New York. And we've seen Volkswagen make numerous investments in companies. Mercedes has made investments, Tesla, all of these companies. But what's really interesting is the companies they're investing in. For example, General Motors made this large investment in LAC. It's not even producing lithium yet, right? So this is still a few years out before they start producing and before GM can actually take delivery of this lithium. So once again, that's another great sector that I would really encourage your investors to check out. We did a conference I believe it was back in January, February. It's on our YouTube channel, Bloor Street Capital, and it was like the longest one yet, 4.5 hours. We had a ton of companies on there that are all involved in exploration or development of lithium, and also numerous speakers on there, including one person from the General Motors, just talking about their supply constraints associated with securing these metals to build these lithium ion batteries.
Yeah, and and correct me if I'm wrong, but I gotta assume that accumulating an investment position is challenging in lithium. That it's not sort of one of the more liquid parts of the marketplace.
Yeah, there is one ETF in the US. I'm just looking up the symbol right now. I believe it's LIT is the ETF. Let me just pull it up here. Yeah, it's called the Global X Lithium and Battery Technology ETF in New York. And yeah, it's up 12% on the year. It's had a big pullback, okay? Like 2000 and like the move from this thing, just to give your viewers an idea of what's happened within the space. This has gone from $20 in 2020. It traded all the way up to $95, and now it's trading around $65. So a bit of a pullback, but I would say it's just a pullback before another big move up. Because once again, as everybody knows, these countries throughout the world are moving toward these. I believe the state of California is going to do away with the sale of gas cars by, I'm not sure if it's 2030 or 2035. The UK is doing the same thing. Many countries around the world are going to stop the sale of gas cars by 2030 or 35. And once again, it's this big push toward EVs. But I would say one thing people aren't really talking about, governments and all these OEMs, is the ability or inability to secure these raw materials, because there's just not enough being produced. And so therefore, all these lofty goals that these governments have, they're not going to be able to do it.
Yeah, no, that's and it's not it's to your point. It's a at least for now, it's an unstoppable trend because the lawmakers also just want to kind of keep on pushing it out there. That's it, when you have a political backing behind a particular theme, that's going to keep the momentum going.
Oh yeah, that's number one driver. That's the number one driver of what's happening within the nuclear space, and the number one driver of what's happening with EVs and battery metals. It's all about government policy, and that's what's creating the change. And Michael, I should also jump in and just talk. I mentioned this earlier about what China is doing with nuclear energy and their big build out of the nuclear energy industry. They did the same thing with battery metals. And this is one of the interesting points about battery metals and that whole sector. 10, 15 years ago, when nobody was even thinking about EVs or battery metals, China was getting involved, and they saw that's where the future was going. And now they are the single largest, not, they produce very few metals, but what they do is process them, okay? So if you're an OEM and you need a lithium ion battery, you have to go to China, okay? They produce 80% of all the lithium ion batteries in the world. And this is one of the big problems that lawmakers and governments around the world face right now, is that you're beholden to the Chinese. And this is why the U.S. or the governments in the U.S. and many other Western countries are making this big push toward these and just onshoring anything and everything to do with EVs and lithium ion batteries.
Yeah, no, 100% on that. Okay, now I know you wanted to make the focus of this Twitter space more on the precious metals, gold side. So let's take a step back and do kind of a 30,000-foot view on investing in gold historically, the last 10 years, and today. Historically meaning very, very long term. Yeah, there's been a lot of excitement around the idea that gold might finally break out of its kind of a long period of nothingness, right? That really started, I think, in 2012, as I recall. But how do you view the current price movement in gold and demand in general in what looks like some increased excitement, but maybe still some skepticism?
Yeah, no, you make a very good point. And listen, one thing I always tell people, gold it's not going to make you rich, but what it is going to do is protect what you have, okay? And it's been around for 5,000 years, and it's not going to go up by 50%, but it's not going to drop by 50% either. So my opinion is you use a little bit of gold in your portfolio, whether it's 5%, 10%, maybe 15%, just to add security. to it. And one of the issues that I want to touch on before we get into the details of gold, you'll hear a lot of people say, oh, yeah, well, it's beat the S&P over 10 years or 20 years or 30 years. And as you and I know, you can take numbers and manipulate them any way you want. And I'm not going to do that. I just think gold, for many reasons, is a very safe and secure reason. And some of the reasons why I invest in it and why I would encourage your listeners to invest in it is because number one reason, it's a hedge against inflation, right? And one thing we've seen here in the last few years is that inflation is running a lot higher than the governments are telling it is. And so it's just another way to kind of hedge against your inflation. So if inflation is eating away at your portfolio 5, 10, 15% a year, who knows what it is, this is a way to prevent that, right? Because gold is moving up. Like I said, it's not going to go up 50% a year, but I think it's going to be slow and steady, 5%, 10%. Year to date, I believe it's up 6%. And another reason why you want to own it is because it's a store of value, right? And nobody can take it away from you. And the other reason why I like it is the protection against uncertainty, such as geopolitical risk. And the other benefit has to do with the volatility. Like I mentioned, it's not going to be like Bitcoin that's going to be going up 50% or 100%, but neither will it drop 50%. So these are all reasons why I like gold and why I think it can benefit your portfolio. And you can sleep at night. You don't have to worry about the government coming in and imposing regulations, right? Just because it's been around for so long. And so these are the reasons why I like it. Now, to your point that it hasn't performed like Bitcoin or so many other investments we've seen in the last 10 years. And I think a lot of it has to do with the fact that there's a lot more competition, okay? If you look at the last cycle where gold peaked in 2012, just think about what's happened in the last 10 or 12 years, right? 12 years ago, there was no cryptocurrencies, there was no social media stocks, there was no EVs or lithium-ion batteries or no cannabis. And now you have all these new asset classes. And I really think that's a big part of it, is that you just have these new asset classes that have come along and they're taking up trillions of dollars, and that money's not going to gold. And especially when you look at it from a demographic point of view, I think the people that historically that have been involved in gold, they tend to be older, and the people that are involved in these other asset classes, let's just say cannabis or EVs, they tend to be younger. And when you look at it, like if I speak to my son, he knows what a Tesla is, right? He knows what an EV is, and he can relate to that. With gold or silver or any other precious metals, it's really tough to relate to that.
Yeah, no, and it's interesting, the demographic differential between older investors liking gold and younger investors liking more digital assets, I think makes a big difference in terms of leveraging, right? If you equate leverage from the standpoint of it means take on more risk, and younger people tend to be riskier than older people, and they steer themselves towards the Bitcoins of the world, so to speak, that itself makes the volatility difference pronounced, right? Just because there's more speculative fervor from a younger demographic.
Oh, that's so true, right? And when I look at myself, like I said, I don't buy gold to be rich. I buy gold so it protects what I have, right? And it's just a form of, it offers me protection against inflation. It's a store of value. And the other thing I like about it, if you want to buy the physical or gold coins, you can actually hold it in your hands, right? Nobody's ever going to take it away from you. And I understand. I'm never going to diss anybody for investing in cryptocurrencies or in Bitcoin, because Bitcoin has done very well and it shares many of the same characteristics as gold, but you can never hold it in your hand, right? You're right. From a risk point of view, totally different characteristics.
Okay, now there's a lot of different ways of allocating to gold. There's obviously off the grid, meaning you own it directly, which I think the true gold fans prefer, which makes a lot of sense. There's also royalty companies and miners in general. Lay out for the audience the different categories of playing off of gold and what are some of the benefits or negatives of some of those investment opportunities.
Yeah, to your point, if you want to, some people want to take possession of the gold, and that can be somewhat onerous. Myself, I prefer the GLD, which is just the ETF that trades in New York. And it's like you can buy it and sell it at any time throughout the day, and it's got lots of liquidity, and that's what a lot of hedge funds use, a lot of institutional investors. That's how they want to trade it. And if you want to trade silver, there's another one called SLV, same sort of thing. It's a physical ownership of gold, and I would highly recommend either one of those. The other way to play gold, of course, is through gold mining companies. You can buy Newmont in New York. The symbol is NEM. It's the world's largest gold producer. They produce approximately 6 million ounces of gold a year. The stock hasn't done that well. They've ran into numerous problems. It's down 10% on the year. And this is one of the issues with owning a gold miner stock, because mining for gold, mining for any metal for that matter, it's very complicated. There's just so many elements to I don't even want to bore you with all the details, but just finding the gold or finding whatever metal it is you're looking for takes a lot of time, takes a lot of effort, takes a lot of capital. And this is one thing that happens within the gold mining space. You burn up a lot of capital just looking for it. And maybe I should just digress for a moment before we get into some of the other ways to invest in it. But one of the things that's happening here in the last 5 or 10 years is that companies like Newmont, they're not finding any more gold. So what are they doing? They have to buy other gold companies in order to maintain their 5 to 6 million ounces a year annually. And Newmont is currently in the process, they're trying to buy a company out of Australia called Newcrest. Very large deal. I believe it's around 18 billion. And one of the reasons why they're trying to do this is because they're not finding any more gold. 3 years ago, they bought another large gold company based in Canada called Goldcorp, and they did the same thing then. So this is what's happening, right? In order to maintain your 5 to 6 million ounces a year, you got to buy other companies because they're not finding any more gold. And this is another reason why the gold price is going to go up, in addition to the reasons I have already mentioned. Another way you can play gold is through an ETF. If you don't want to buy one gold company like a Newmont or like a Barrick Gold, you can buy an ETF. The big one that a lot of institutions play is called GDX, and it might have 10, 15, 20 different companies, so therefore you have some diversification. So if you have one company, for whatever reason, let's just say they own a mine over in Mongolia, or maybe in Panama, or maybe in the DRC, and the government comes in and says, hey, you know what? We're not happy with the terms. We want to renegotiate the terms. And the stock drops 25 or 50%. And this happens all the time in mining. So that's why you can buy an ETF, so you're diversified, and you don't have to worry about those geopolitical risks. And then, of course, the last way you can play gold or precious metals is through a royalty company. And a royalty company, just to provide a little bit of background, it's not a mining company per se. What it is a financing company, and they provide innovative financing solutions to mining companies, and they provide capital because, like I said earlier, mining companies use up a lot of capital. If you want to build a mine, it might cost you $1 billion or $2 billion. So how is a mining company going to get that money? They can go to the bank and take on debt. They can go to shareholders and issue more equity, or you can go to a royalty company and get cash. And then in return for that cash, the royalty company will take a portion of your production in the future of your gold and or silver. And one of the great things about the royalty model is that there's 3 big advantages for investors. One, you have gold exposure to gold and silver. 2, you don't have any exposure to the risks of operating a mine, such as geopolitical risk or exploration risk or inflation risk. And 3, probably the most important reason, is you get a free optionality on upside potential associated with exploration. So like I mentioned earlier about Newmont, they'll spend tens of millions of dollars every year looking for gold, and a lot of times they're unsuccessful, but sometimes they're very successful. And I'm going to provide an example of how this can really benefit a shareholder in a royalty company. But the world's largest royalty company is called Franco-Nevada, and it trades in New York under the symbol NAV. When the company was first formed back in the 1980s, they bought a royalty on a mine in Nevada called Goldstrike, and they paid $2 million for that royalty. Well, that mine turned out to be one of the biggest gold mines in not only North America, but in the world. And that $2 million royalty has paid Franco-Nevada $1 billion in cash flow. So this is one of the great things about investing in the royalty model. And you have exposure to all these mining companies that are out there spending hundreds of millions of dollars on exploration. And you, as a royalty company, you have exposure to that. You can benefit from that, but you don't have to put up one penny. So once again, just to recap some of the ways you can invest in precious metals. One, you can buy an ETF like the GLD. You can invest in a mining stock like Newmont or Barrick Gold. And three, you can invest in royalty companies.
Is it safe to say that royalty companies are maybe the more consistent investment play just because of that financing side of things?
Yes, and 100%. And not only from a financing, the big thing is risk. I can't stress this enough, but when you invest in any mining company, doesn't matter what sector, there's a lot of risks involved, okay? And just extracting gold or silver or uranium from the ore, there's a lot of technical risk is associated with that. With a royalty company, you don't have to worry about any of that. The other element, what's very important right now to any and all companies, is inflation and what's happening to inflation. Well, most of these mining companies, like their number one expense would be labor. And of course, if you belong to a big union, you're renegotiating your contract to account for what's happening with inflation. These expenses and labor in general, like labor never goes down. This is one thing that any mining company, any company probably budgets 5% a year, okay? Every year your labor costs are going up at least 5% a year, regardless of the inflationary environment. The second largest expense associated with any mining company is fuel. And they burn a lot of fuel, okay, especially if they're located in some faraway place up in Canada's Arctic or maybe in somewhere in South America, right? They burn through a lot of fuel. And as we know, everybody knows what's happening with fuel right now. It's trading around $70 a barrel. Was over 100 not too long ago, but that's also a huge expense. Well, royalty companies, they don't have to worry about this. They don't have to worry about labor inflation. They don't have to worry about what's happening with the price of energy because they have this agreement, and regardless of what happens, they're owed a certain number of ounces of gold or silver every year and indefinitely. And I guess the other point I should make too, in line with your question, is if you're a generalist investor, there's funds out there that specifically are set up to invest in mining companies, gold, silver, or whatever. And so they have a lot of expert knowledge. But there's a lot of investment companies out there that don't really have that expert knowledge in precious metals. But I'm going to refer to them as a generalist investor. And they don't have that knowledge, right? They don't know anything about geology. They don't know anything about, or they know very little about jurisdictional risk. But with a royalty company, you don't have any of those risks. So that's what they tend to invest in. So if you look at a name like Franco-Nevada or Wheaton Precious Metals or Triple Flag or Sandstorm Gold, these are companies that offer exposure to gold and silver, but they do so in a much safer manner. So that's where you tend to get a generalist investor involved.
How do you find investors allocate towards those different ways of playing gold between like a GLD type of ETF or the miners or the royalty companies? Do they do an equal weight type of exposure, or overweight one over the other? What's sort of the, from an asset allocation mix, the typical weightings you see?
Well, I can't speak for these companies, but without mentioning any names, and some of the companies that I speak with, or some of the funds that I speak with, it all depends on their mandate and the size of their fund. Now, a lot of these companies are set up specifically to invest in mining companies or precious metals companies, so they have to invest in mining companies. Typically, there's three classes of companies you can invest in: producers, such as Barrick Gold or Newmont or Kinross or Agnico. And then there's development companies, companies that are very close to, maybe they're going into construction. They're actually constructing the mine. And then the third class would be exploration companies. These are companies that are just out in the middle of nowhere, drilling holes in the ground, trying to find gold, silver, uranium, or lithium. And so most funds are kind of built around those three asset classes. And then depending on the mandate of the fund, then you're going to allocate more, probably more toward the producers because they tend to be safer than an exploration company, for example. And then, of course, you have generalist funds that might have 10 or 20% of their portfolio invested toward, they want gold exposure. How are they going to do that? They're going to invest in solid names like some large producers, or maybe in ETFs, or maybe in the royalty companies.
What about poor man's gold, silver? Which is always to me kind of a funny way of describing silver. A lot of people use silver also as a tell, right, on markets, the economy, silver gold ratio as an example. But is there anything to the idea that the two tend to kind of move somewhat in lockstep, that silver just correlates very highly to gold?
Yes. Yeah, there's a lot of research on that, and they do. Gold tends to move first, and then silver moves, and the move in silver can be quite massive. In terms of gold, I think gold is a lot more mature, and not to mention it's a lot more expensive at $2,000 an ounce, so it tends to move a lot slower, right? Whereas silver, trading at 24, 25 bucks an ounce, it's a lot cheaper. So I think that's more retail people playing that. But the moves can be quite violent at the same time. One of the interesting things about silver is I believe 50% of its demand is for industrial use, whereas gold is purely, it's not even a commodity, it's just a monetary asset, right? Whereas silver, it has both a monetary component but also an industrial component. It's being used a lot in solar panels. And a lot of the growth that's happened here in the last few years is coming from solar panels. So once again, it's going back to the theme that we discussed earlier. Governments are pushing these big green economy or decarbonization mandates, and that's leading to higher interest in silver from many of these industrial companies. But at the same time, I should bring up another interesting point about silver. 70% of all silver comes from a byproduct. It's produced as a byproduct from some other metal like gold or copper. And so there's very few pure silver companies in the world. And one of the reasons is because it's so damn hard to find and so hard to mine. And it tends to be, without getting too technical, in travel in these veins. And they're very narrow veins, and they're very hard to find.
What about other kind of undercover or under-focused on commodities that you like to look at that you find tends to not get as much traction or attention?
That's a very good question. I mentioned this earlier, but I would say from a long-term supply-demand point of view, it's got to be uranium. Yeah, without a doubt. And the reason is because there's so few companies producing it, and yet there's so much demand. The future demand for uranium is going to be off the charts. And I know it's trading around, let's just say it's trading around $60 a pound in the spot, but there's so much demand. Let's just say tomorrow the U.S. government comes out and says, you know what, we're going to place these hard restrictions on Russia, and any form of uranium that comes out of Russia, I'm telling you, uranium would probably rip 25% in overnight. So I can't stress this enough. Like, the supply-demand fundamentals for uranium just look amazing. And even if the U.S. government doesn't do that, okay, because because the U.S. is the largest consumer of uranium, you don't want to disturb that, right? Because these nuclear reactors need uranium, and you got to get it from somewhere, even if it's coming from Russia. But with this massive build-out happening in China and other countries throughout the world, uranium's only going one way, and it's going higher. And maybe it's not going to go up 25 or 50% the way a lot of people want to see it go, but it's going higher.
Yeah, I don't disagree. And also, I'm going to make the assumption that it's not like you're suddenly going to have a whole bunch of IPOs coming out to fulfill the demand as it accelerates, right? The barriers to entry are pretty high for new companies.
Oh, yeah. And this is one other thing I should stress, too, because you touched on this earlier. You mentioned ESG, right? And when it comes to building a mine, like, things have changed so much just in the last 10 years, never mind the last 20 or 30 years, right? 20 or 30 years ago, it was easy to go build a mine in Canada or the US and have the permits in hand relatively quick and just start. Maybe you could start producing whatever metal you were trying to mine within 6 or 8 years. Now you're looking at 15 years, Okay, so from exploration to actual production, you're looking at 15 years. And a big part of that has to do with the permitting process. It's so onerous in Canada, in the US, and these other Western countries. And and then, of course, it all depends on what state or what province you're operating in, right? The state of California, very tough to do any mining. But at the state of Nevada, one of the greatest mining jurisdictions in the world, you can get things done relatively quick there. But once again, it doesn't matter what metal you're going after, the time to do it takes a very long time. To your point, no, like if you get any IPOs coming out within the uranium space, it's for an exploration company, a company that's going out in the middle of nowhere, drilling for holes, hoping they're going to find uranium. In terms of actual production coming online, the Kazakhstan could start pumping out uranium in large amounts, much the same way can pump out oil. But I don't think they want to do that. What they're trying to do is they got very disciplined here in the last 10 years, and they're trying to control the supply and also the output of uranium. I think you don't have to worry about any massive production coming online. I should also state, I mentioned earlier too, that the price is trading around somewhere between 55 to 60 bucks a pound, okay? And it's going up, but it's going up rather slowly. The last time it peaked, I believe it was '07, it got up to $120 a pound. So we got a long way to go before it gets back to its all-time high.
Yeah, that was sort of a broader secular time period. If you were going to put a time frame around how long a cycle in uranium might last, and by last I'm just talking about sort of fairly persistent up and to the right type of movement. Is there anything in history that would show or suggest that these cycles tend to come in 3, 4, 5 year type of phases, or is there a different dynamic this time around?
I really don't know the answer to that, Michael. I think as long as the governments keep pushing this decarbonization and this whole green economy, it's going to last a long time. This is going to be different from any other point in history.
James, where do people learn more about what you do?
Once again, you can check out our YouTube channel, Bloor Street Capital. There's a ton of free information on there on anything and everything to do with resources. And that could be gold, silver, copper, battery metals, uranium. You can also check out my Twitter handle, James Connor 1999, or you can also check out our business handle, Bloor Street Capital. And once again, I just want to reiterate our upcoming conference this coming Friday, June the 23rd at 10 a.m. Eastern. We're going to talk about gold, silver, and royalty companies and how they can benefit your investment portfolio. We're going to have a number of expert speakers on there talking about gold and where the price might be going, and also silver, and also some companies in which you can invest in.
Yeah, good place to wrap this Twitter space up. Everybody, please make sure you follow James Connor. Sorry about that random doorbell ring that you heard as I asked that question. I had to quickly mute myself. The joys of being live with this kind of stuff. Anyway, thank you everybody for joining. Thank you, James. And again, I'll have this as an edited podcast probably in 3-4 days here. I appreciate it, everybody.
Thanks for the opportunity, Michael.
Thanks, James.